have $1 million in my portfolio. That means I'm ready to retire, right? Today, we're going to be talking about $1 million portfolio and what that does and doesn't mean for retirement. For many folks, they've aimed for that $1 million portfolio for many years and have seen that as a benchmark of when they might be ready to retire. So today, we're going to break down 3 things to know before you retire and use $1 million portfolio as an example. If we haven't met yet, I'm Josh Leonard, President and Financial Advisor at the Leonard Advisory Group. We started this YouTube channel to help educate those nearing and in retirement to retire with intent and have retirement success. If you haven't already, be sure to like and follow. Any feedback, feel free to leave in the comments of this video. We'll jump into 3 things to know before you retire, and the first up will be that not all assets are the same. If we take a look at 3 different types of money, we'd say there's 3 buckets or 3 different ways that we can save money over time, and they have different tax classifications. The first bucket would be taxable assets. Most commonly, we see these as CDs, savings accounts, and investments like stocks and bonds outside of your retirement accounts, like an IRA or 401k. Which brings us to the next bucket, your tax-deferred bucket. In the tax-deferred bucket, we'll have things like your IRA, your 401k. If you have a 403b or other retirement savings accounts like that, those would be included in that bucket as well. The third bucket we have is the tax-free bucket. In our tax-free bucket, we'll have things like our Roth IRA, or possibly our Roth 401k. It's important to denote the differentiation between a Roth and regular IRA or 401k, as the IRA or 401k will be tax deferred, meaning we put the money in without paying taxes on it, in most cases. The money will grow over time, and when we distribute, it'll be taxable at that time. Our tax-free bucket, containing our Roth IRA and our Roth 401k, are tax-free as long as we follow certain rules, but in general, we put after-tax money into those accounts. It grew tax-deferred and distributes tax-free. So ideally, if we could, we'd want to have all of our assets there, but in most people's situation, it doesn't actually make sense to do that. It makes sense to get the tax deduction in their higher earning years. But when we go to retire, we need to make sure where we're pulling assets from and be sure to be able to calculate the appropriate amount of tax that Uncle Sam will be taking out of that income source. When we look at other income sources as well, it's important to look at things like your Social Security. Many folks don't realize that their Social Security can be taxable based on their other income sources. So if you're retired and married filing joint, claiming Social Security, and your modified adjusted gross income exceeds $32,000, 50% of your Social Security will be brought into your taxable income. Now, when I say that, many folks hear 50% of my benefit will be taxable. Well, 50% of it gets brought in to whatever tax bracket you fall into. So if we jump up here to our tax brackets, if you're married filing joint and you fall into the 12% tax bracket, half of your Social Security benefit would then be taxed at that 12%. The next tier up is anything above $44,000 in modified adjusted gross income. So for most folks that we work with, we're going to say roughly 85% of that benefit is going to be taxable. Again, if we go up to the tax brackets, if we think of our Social Security income and that 85% of it would be taxable, assuming we fall in a 12% tax bracket, we're going to lose about 10% on that income overall. So we want to be aware of that. As we walk into retirement, we don't want to assume that taxes won't be paid at all. As we look at our tax brackets, though, it's also important to highlight that if we're falling under $94,050 in income, we might be able to sell off some of those stocks that we have in our taxable bucket that maybe we've been afraid to sell for the impact of capital gains. If we're falling under that $94,050 benchmark, we'll pay 0% in capital gains. So for some folks, that might be a way to supplement income for some of the fun things you're looking to do in retirement, like take a trip. The second thing to know before you retire would be how you're going to withdraw your income. Now, a common mistake that we see is folks have done really well in their retirement portfolio over the last group of years, especially when the stock market's been doing well. So they want to stick with that same plan. They want to stay with a heavy allocation to stocks. Now, if your stomach can take it, maybe that works for you. But if we look at the screen here, we have a quick example of two brothers, one that retired in 1990 and one that retired in the year 2000. Steve, retiring in the year 1990, decided to take $30,000 a year out of his $500,000 portfolio. At the end of the first 10 years of retirement, he ended with a balance of a little over $1.2 million. Now, his brother Bill retired 10 years later. Starting in the year 2000, he also withdrew $30,000 a year out of his $500,000 portfolio. At the end of that 10-year time period, he had $156,000 left. We call this sequence of returns risk. So the individual years and how the market performs can impact when you're withdrawing from a portfolio. We might also call this reverse dollar cost averaging. If we think about our accumulation years or our years leading up to retirement, we're saving as the market is zigging and zagging over the years. In our accumulation years, we're dollar cost averaging, where we're saving a little bit from every paycheck going into our 401ks or IRAs, and when the market dips down, we're just buying things on sale at that point. In retirement, the tables have turned. Now we need to be very careful what assets we're withdrawing from. At the Leonard Advisory Group, we take a 3-bucket approach to retirement income. Our first bucket is going to be our cash bucket. And here we're going to say 3 to 6 months worth of expenses we want to set aside in something boring. So it might be a savings account, it might be a short-term CD that we can exit out of if we need the money, or we might just keep that money in our bank account. This is to cover those emergencies. We all have emergencies come up when we least expect it. So we want to make sure that we have some cash set aside. Now, if you also have a very short-term goal, like in 6 months from now, you're going to buy a new car, you may want to also keep that money in your cash bucket as well, so it's not subject to the volatility of the market. Our second bucket would be our income bucket. Now here we want to use very stable assets that can produce income for 6 to 10 years. What this allows us to do is be patient with our third bucket, our growth bucket. In our growth bucket, we're going to stay in that stock allocation that the two brothers had, but we can be patient. We can let the market go through its cycles, as we'll have 6 to 10 years worth of income set aside. So in that growth bucket, we're eventually going to use that to help replace our income bucket or maybe our cash bucket as well. By using that 3-tiered approach, we help reduce that sequence of return risk that we saw with the two brothers. Now, the third thing to know before you retire is your costs. What do you need to sustain life in retirement? For many folks, that means doing a budget. If you don't want to do a budget, I got a really easy exercise for you. You take the income coming in, you subtract taxes and what you've saved, and what's left is what you're spending, right? So after we take taxes out of the picture and whatever we're putting away into our retirement accounts or maybe a savings account, what's left over is our expenses. Unless someone's tapping into your bank account and taking the money out from you. But we need to have a good idea of what that budget is and how those expenses might shift once you are in retirement. Another big area that people often miss is your Medicare or health cost in retirement. We'll go through an example here shortly of a couple that was looking to retire early at age 62. Rather than waiting till age 65 and plus when they could get on Medicare, they would need to pay out-of-pocket medical costs. In their case, it was going to cost about $30,000 a year. That is a pretty big expense for a couple years in retirement, so we want to know that ahead of time. We don't want to walk into retirement and then be shocked at the cost of healthcare. Another thing that we want to consider is our bucket list. Have you always dreamed of going to Italy for a 10-day vacation or renting an RV and hitting up all the national parks? Whatever those bucket list items might be, we should allocate money for that and include it in our expenses prior to retirement, not after. Now, all these things we feel it's best to be pulling into a comprehensive plan so we can take a long-term look out to see the implications. So we'll jump into a quick case study here. This is an example of a client that came to us a few years ago. Of course, we've changed the name and rounded off some figures to make their situation slightly different. But here we have Jack and Diane Saylor. They're both turning 62 this year, and they're looking to retire right at age 62. They're married, of course, have a son and daughter. Any assets that are left over, they'd like to go to their children, but first priority is having a successful retirement. If we look at their net worth, they have about $35,000 in an emergency fund. They have a taxable investment holding some stocks of a little over $100,000. Diane has an IRA that she just rolled over from a previous employer of about $400,000. Jack, the same situation, and they both have Roth IRAs as well. The final asset we have listed on here is their house. They assume their house is worth about $450,000. So this puts their total net worth at about $1.4 million. Now, if we subtract out the house, they're almost exactly at that $1 million point. When we look at retirement, they currently are spending about $125,000. Once they hit Jack's age 83, or once they're both about 83, they assume their spending will trend down a little bit to about $100,000. We're going to take those expenses in a plan and assume inflation over time, so they'll continue to go up. But when we put their basic information into a plan, we can see this might not be a good plan for Jack and Diane. Based on the financial plan here, their assets would only last till age 75. Now in this scenario, they're assuming they're going to start Social Security right away and withdraw from assets to cover any other expenses they have. When they met with us, we brought up healthcare costs as well. So once we add those in, the situation gets even worse. At this point, they lost 3 years of funding due to that additional cost of health insurance for that 3 years. And now their assets would only be lasting till age 72. So we put together a couple options of ways to have a more sustainable retirement plan for them. The first step we took is push their retirement ages out till age 65. So this might be tough, but they needed to work an additional 3 years to make it last. Just through that, they gained 20 years of funding in retirement, and on a base level, it doesn't look like they would run out of income. Now, if we do a Monte Carlo scenario where we're going to run through 1,000 different market scenarios to see if it's a really good market, an average market, or a below average market, we could see there is still some risk there. With a below average market, they might run out of assets early, in their early 90s. So we'd say this has a 73% probability of success. We pulled another lever and said, hey, what if you defer Social Security till age 70? By deferring Social Security, we increase their probabilities for retirement. Their probabilities of success then went up to 94%. In that case, they felt pretty comfortable. This midpoint would have them passing away at age 95 with a little over $2 million. Even in a below average market, it looks like they're going to have enough money, and they don't know if they're going to live all the way till age 95. So they said, hey, what we didn't talk about before is we have some bucket list items. We want to spend a little bit more money in those early years of retirement when we can still get out, go, and do some fun things. So we added in an additional $10,000 of expenses for the first 10 years, and it still landed them at a probability of success of 87%. Now, in this case, Jack and Diane felt pretty comfortable with that retirement plan. They felt like they could do what was important to them by working an additional 3 years and making some minor adjustments to their plan. When you're thinking of retiring, it's not just about the balance in your 401k or the amount of assets you have. What's actually more important is your lifestyle and what you're looking to spend and what your goals are in retirement. I encourage you to sit down with a financial planner or someone to help you map out these multiple different areas to make sure you're on the right track before you pull the trigger for retirement. If you're looking for assistance or looking for a financial advisor, feel free to check out our website at leonardadvisorygroup.com, where you can get in touch with someone on our team. Thanks for watching. Be sure to like and subscribe.